So good morning or good afternoon, everyone. Welcome to this HYI IAS Supervisory Dialogue on Conduct and Culture. My name is Janina Voss. I work with the Access to Insurance Initiative Secretariat, or HYI. And I'm very happy to introduce our speakers today and introduce the call. Before we start, just a few small remarks on housekeeping issues. So this dialogue is being recorded and we will make it available to other supervisors on our e-learning platform, connect.hyi, but it will only be available for insurance supervisors and not beyond that. For sound quality, you are muted, but please make active use of the chat box to ask questions. And also later in the Q&A, if you want to ask a question, please do raise your hand and you are able to unmute yourself then. This call is being translated to French. So if you would like to listen into the simultaneous translation to French, the instructions are being shared in the chat. And if you have any issues with that, please do not hesitate to contact us, the HYI Secretariat, and we will help you out. Before introducing our speakers for today, we are also joined by Manuela Zweimüller, who's Head of Implementation at the IAS, our partner in organizing these calls, and I'll hand over to her for a few welcome words as well. Manuela?
Thank you so much, Janina, and hello et bonjour à tous. As Janina has said, I'm the Head of Implementation at the IAS, and on behalf of the IAS, I'm very happy to welcome you all today to the joint dialogue on conduct and culture. It is really great to see so many of you joining and interested in this very important topic of insurer culture. And I'm also very happy to see the renowned speakers for this dialogue with us, which will give us a broad insight into conduct and culture, including the progress of the IAS work on this. And as you may all know, we have a market conduct working group at the IAS, which is dealing, amongst others, with conduct indicators and also the insurer culture topic. So the HYI provided on its website a definition which focuses on norms, values, attitudes, and behaviors of insurers that characterizes the way in which the insurer conducts its activities. And that is exactly key, the way in which the insurer conducts its activities. So culture is complex. Culture influences how an insurer or intermediary designs products or deals with clients, for example. Culture is essential for a fair treatment of customers. And this is why supervisors should really pay attention, and in particular when they are on site, on which culture they are finding there. It's not only the tone from the top, it also needs to be lived on all levels of management. And to provide a good example, you need to walk the talk. With this, I wish you a fruitful dialogue and valuable insights into the fascinating topic of conduct and culture today. Enjoy the dialogue.
Thank you very much, Manuela, for these introductory words. So with that, I'd like to introduce our speakers today. First, we have Lauren Eckermann from the IAS, who will kick us off by sharing some key messages from the recent IAS issues paper on insurer culture. Lauren is a senior policy advisor at the IAS Secretariat and focuses there on the supervision of conduct and governance issues in the insurance industry. Before that, before she joined the IAS in December 21, Lauren spent almost 8 years as the conduct regulator of financial services and financial markets in Australia, the Australian Securities and Investments Commission, where she worked in roles spanning enforcement, policy development, supervision, and strategy. Welcome, Lauren. And after Lauren's presentation, we will enter into a panel discussion moderated by Charlotte Cross. Charlotte was appointed chair of the IAS Market Conduct Working Group in September 2021. And alongside this role, Charlotte works for the UK's FCA as head of Department for Wholesale General Insurance Supervision. And in her role at the FCA, Charlotte has led the COVID-19 related business interruption work as well and looked at a range of supervisory issues, including those on diversity and inclusion, climate change, and conduct. And before joining the FCA, Charlotte had also spent 19 years in an insurance firm, the majority of this time as a senior international property treaty reinsurance underwriter. And on the panel, we are very pleased to have two more colleagues. Firstly, Vanessa Porayachi from the Financial Sector Conduct Authority in South Africa, the FSCA, where she started working as an insurance compliance manager in July 2015. And in her current role in the Conduct of Insurance Business Supervision Department, Vanessa manages a team of analysts and assists the FSCA in adopting a risk-based approach to supervising the conduct risk of long and short-term insurers. And secondly, we are also very pleased to have Lim Sin Ying from Bank Negara Malaysia on the panel. She joined BNM in 1999 and has served across a range of core central banking and development functions. And in May 2019, Sin Ying started her new role as the director of the Consumer and Market Conduct Department. So welcome to all of you. It's a great pleasure to have you all on this supervisory dialogue today. And with that, I'd like to hand over to Lauren to start her introduction.
Great, thank you very much. So if we can have the slides come up. So thanks for the opportunity to join you today and to share with you the work that the IIS has been doing on the topic of insurer culture. We can go forward. And again. So in this brief opening presentation, what I would like to do is cover four things. I'd like to introduce for you what is meant by culture, what we consider influences culture, why we think culture matters for insurers and for supervisors, and then fourthly, draw to your attention the IIS issues paper on insurer culture, which was published in November of last year, and to which you can direct yourself and read more about this topic. So then, taking these four components in turn, first of all, on the next slide, what do we mean by culture? So at the IIS, we have a definition for what we consider is corporate culture. And that definition is, it's the set of norms, values, attitudes and behaviours of an insurer that characterises the way in which the insurer conducts its activities. So you can see from this definition, it's not necessarily something you can put your finger on. It's more so a collection of ingredients, and it floats and operates and comes together as a result of many different components existing throughout the structure of the insurer organisation. So you might then think, well, that seems awfully hard for an insurance supervisor to see or to assess or to be able to influence. But what I hope to do is continue to tell you a little bit more about it and hopefully make it seem a more tangible concept. So if we can have the next slide, please. So still on this question of what do we mean by culture, I want to show you this schematic diagram or this metaphor of an iceberg, which is used by the De Nederlandsche Bank from the Netherlands. And I really like this way of understanding what is culture and what contributes towards culture. So in this metaphor, above the surface of the water is one part of the iceberg. And this part is the behavior. And it's above the surface, it's observable, it's something that we can see. And it's the behaviors of the management and of all the employees working within the insurer. And here, the DNB pays particular attention to the behaviors related to decision making, to leadership, and to communication, because it considers those behaviors as especially important for groups that are working together and especially important for the accomplishment of goals and the achievement of results. So if behavior is the small part above the surface, the really large mass sits under the surface and is not observable, but is very significant in creating the shape of what you do see above the water. So here there is the part of group dynamics and then the part of mindset. And those are the underpinnings that bring into existence a certain kind of behavior at the top. So group dynamics talks about interaction in a group, and it's important because it affects the overall group effectiveness. And mindset is the sort of deeply held beliefs and values which create or influence the group dynamics and in turn create or influence certain behaviors. So all of that together is another way to think about what is culture. On the next slide, please. To the question of what influences culture, what I've presented here on this slide is a schematic diagram that comes from the IIS's issues paper on insurer culture published November of last year. And I'd like to spend a little bit of time taking you through these three different influences, these three different buckets that we say are important contributors to a resultant culture that might exist within an insurer. So first, organizational levels. I think it's important to consider culture as being designed and created and brought into effect not by just a small number of people, but rather it's about everyone, and it's about the influence and interaction of everyone. So if you start at the top, you've got the board of directors, and they have responsibility for setting a certain tone and deciding upon a certain culture that they want to have exist. And then they have responsibility also for the way that they interact with each other and the modeling that they do in that way. So they, as a board, need to act with a culture of openness and critical debate and critical challenge and an interest in receiving all the relevant information being reported up to the board. Then you've got senior management, and they are responsible for promoting sound risk management, compliance, and fair treatment of customers. And so the board and the senior management together, you might think of as critical for setting the right tone from the top. But that's not enough, because it's the middle management and all the way through the lower levels, all the way to all the frontline staff who are actually doing the selling, who are actually servicing customers, interacting with customers, deciding claims. It's through all of those levels that you need the right culture to permeate. And that's where you're going to see whether the tone that the top believes it is setting in place is actually embedded and actually translating into practice into the day-to-day operation. Next, if we look at the bucket of cultural drivers, so these are the components or the ingredients that we think really have an important bearing on the ultimate culture that exists within an insurer. So this is about having the right values, objectives, strategies, purpose. And here I wanted to put to you the contrast between an insurer who might have an objective, a strategy, a purpose, very driven by maximizing short-term profit. Contrast that with an insurer who might have objectives, strategies, purpose, values that are all about best serving the customer, meeting the customer's needs, being a positive contribution to the customers. And you can see how that sets in place very different cultural underpinning throughout the organization. Other important cultural drivers we think are leadership accountability and responsibility, clear and transparent internal communication, and appropriate remuneration systems so that you have pay mechanisms which are driving good behaviors, and also performance systems, which includes effective consequence management for misconduct. Those we think are important drivers of culture. Then the third bucket is governance and practices. And this is really important to have effective controls and to have the right processes and policies so that employees within the organization are reminded and it's reinforced to them what is expected and what is not tolerated. You can't have a message coming from the top that says one thing and then lack the controls and the processes and policies to reinforce that. You need consistent messages and you need that understood, and you need consequences for, firstly detection and then consequences for the staff who breach those expectations. Just before moving on, I wanted to mention that some of these cultural drivers are the subject of current IIS work. So in particular, the governance working group is continuing to do more work examining remuneration and how that can drive appropriate outcomes. And both the governance working group and the market conduct working group are looking at diversity, equity, and inclusion as a topic and considering the link between DE&I within an insurer and the corporate culture that results, and also looking at the idea of how an insurer can best serve the diversity that exists in the customer base and how it can interact with customers in a way that is inclusive for those customers. And those things we think also feed into corporate culture. Next slide, please. So just to drive the point home about why we think culture matters for insurers and supervisors, really it's because a positive, an effective, a sound culture reduces the potential for misconduct and it increases the potential for good prudential and conduct outcomes. And on the flip side, if you have an ineffective or an unsound culture, that can lead to riskier behaviours or excessive risk-taking. And that in turn can be bad not just for this particular insurer and its policyholders, but also more broadly for the sector and through to actually being bad for the whole financial sector, the whole financial system as a whole. And why? Well, that's because you can get really large-scale customer complaints, you can get litigation, regulatory sanctions, reputational damage, significant longer-term losses. Final slide, please. So here I just wanted to provide the link through to the issues paper on insurer culture. You can see on the slide the kind of information that's covered in that paper, and I'd encourage you to go and have a read of that if it's of interest. And then all that's left for me to do is to say, please feel free to drop some questions into the chat box. There'll also be an open Q&A opportunity at the end of the session. And with that, I will now pass across to Charlotte to moderate the panel.
Thank you, Lauren. And thank you, Janina, for the introduction as well. So lots of good contents there from the IIS presentation. Certainly some of the bits there that from the FCA point of view, when you talk about that bit at the bottom as to all the things that can go wrong on that last slide, that is why for the FCA we're interested in it. We have operational objectives to protect consumers, protect financial markets and promote competition, and that diagram, the last bit at the bottom, kind of pulls that all together. But now I'd like to ask Vanessa and Sin Lim to join the panel, please, for us to look at some questions together. You stick your there? Yeah, cool. So first of all, the first question, maybe if I can give that to you, Vanessa, to start with, about the importance of conduct and culture. So why is conduct and culture an important topic for your authority?
Thanks. I think for us as the Financial Sector Conduct Authority, culture is currently what we live and breathe. We previously were part of the Financial Services Board, where there was focus in respect of the solvency aspects as well and the conduct aspects, and there was a split, and now we are the FSCA, and that is our only focus. So it is a very strong focus area for us. We found that there is influence on culture. The culture influences the governance influences the conduct, and vice versa. So it's very, very interrelated. To give you a simple example, if we look at an insurer that is developing a product, and if that insurer has the right culture, it will start with that process of product design, and it will ask the question, what is my consumer? What does my consumer want? What does my consumer need? And then it will develop that product to meet the client's concerns. And it will also look at the entire product life cycle. How is that product going to be distributed? What is my complaints process? Is it effective? What is my compliments process? Is it effective? Do I have effective reporting to understand what claims are coming through, what the loss ratios are? So if the insurer has the right culture, then it will automatically have the right conduct, and that will then translate into greater outcomes for the customers. So definitely there is a very strong correlation between the two, and as the conduct regulator, it's a very important topic for us. We have started this journey a few years ago. We are not yet at the point where I can say that we are a fully fledged conduct regulator. There are a lot of areas of work that we need to put in place because we have different sectors of legislation that looks at conduct, and we need to get to a point of assimilating all of those pieces of legislation and working out of the silos that the legislation currently forces us to work into. So we are working a lot closer within conduct of business to try and figure out, for example, the risk ratings of entities that we supervise. We have various brokers, we have insurers, asset managers, lots of entities that operate in the financial industry, and we have slight nuances currently in terms of how we risk rate. So we are still working closely together to figure out how we're going to adopt a consistent approach with respect to how we risk rate. And part of that is a very big initiative that is underway for us right now in the insurance space, which embark on an initiative to have all of the entities that we supervise submit a similar type of return, so that when we do a temperature check with respect to an entity that has a group profile, we can understand what the conduct risk profile is. And regardless of the type of entity that we supervise, we ultimately want to have a good sense of what is the conduct risk nature of that particular entity. Thanks.
Brilliant. Thanks very much, Vanessa. Lots there for us to kind of digest it, very much at the heart of it around the customers and making sure products are right for them is kind of coming through on that. Simba, how are things similar for you or different? Do you see a similar approach?
Actually very similar, but maybe I'll just give you a brief context on the role of the Central Bank of Malaysia. So unlike Vanessa's authority, we are very much an integrated central bank, as in we oversee all bank prudential regulations of all banks, insurance companies, takaful operators, insurance intermediaries, as well as payment system operators. At the same time, we also serve as the conduct regulator. So for those of you who have served on the prudential and conduct side, you know, sometimes these are not exactly harmonious or could be competing objectives. So internally, we too, when I first joined the bank in 1999, conduct was very much more of an implicit function, part of stability. However, in 2013, we modernized all of our acts and we came out with the Financial Services and Islamic Financial Services Act, where we now have, in pursuing the objective of financial stability, the bank aims to foster fair, responsible, and professional business conduct of financial service providers. We also have an explicit mandate to strive to protect the rights and interests of consumers of financial services and products. So rather than it being something implicit, it's now an explicit objective that the bank aims for. Internally, what we have done is we've actually set up a separate consumer and market conduct department. That's the department I oversee. And we oversee the conduct, regulation, and supervision of banks, insurers, and takaful operators, as well as the prudential and conduct regulation and supervision of insurance intermediaries. So as Lauren's earlier introduction slides has clearly illustrated, conduct and culture are interlinked and crucial in the development of a progressive, resilient, and inclusive financial system. So, and Lauren has also quite rightly pointed out that, in my mind, having a reputation for being fair makes perfectly good business sense. Theoretically, financial service providers that actively fosters a corporate culture that focuses on the fair treatment of financial consumers is more likely to have high customer satisfaction and retention, leading to sustained business performance over the long term. Unfortunately, when you have consumers themselves who have unequal levels of financial literacy, when you're in a market where there's a lot of information asymmetry, in that situation, you may have consumers who aren't that there isn't a right environment for consumers to compare and make informed decisions that are the most right for their financial circumstances and needs. So to me, that's where we as regulators, we play that role to correct these market imperfections and to create the right rules and the right environment to ensure that financial service providers who all will talk a good talk about how customer is king and that they prioritize the needs of their customers, but from what we can see so far, they don't necessarily walk the talk. So a good example of how things can go really bad when you have bad cultures would be the global subprime loan crisis that provided clear evidence of how poor conduct by financial service providers can result in massive financial harm, not just to individuals, but to institutions and nations too. So I hope with this introduction, I've given some clarity on why it is not just conduct and culture is important, not just for Malaysia, but for all regulators globally.
Brilliant. Thank you, Sin. Yes, I think there's perhaps many of us as regulators that can relate to your talk the talk, but not necessarily walk the walk. You can see big posters up in offices, but sometimes as you look at the iceberg, as Lauren showed the picture of, and you kind of dig a bit deeper, you might find something that doesn't quite align. And with that, you started to touch on to when things do go wrong. How about we move on to now perhaps compliance and enforcement? What requirements relating to culture do you have in your jurisdiction, and how are you assessing them and enforcing them? Sin, do you want to take that one on as you kind of started on that topic of?
Yeah, that's fine. So I think we compared notes earlier with Vanessa as well. And to tell you the truth, Malaysia did not reinvent the wheel. We actually benchmarked other more advanced jurisdiction, even yours, Charlotte, FCA UK was a treasure trove for us. So we have issued principle-based and outcome-focused policy documents on fair treatment of financial consumers. This was issued in November 2019. And in it, in recognition of, as mentioned earlier, given the important role of culture, we have set in our policy document, the first principle that we've put in place imposes the requirement for the board and senior management to set clear expectations on fair treatment of financial consumers and to ensure that it's embedded in the financial service provider's corporate culture and core values. So in terms of assessing compliance, usual thing, I myself started my career as a prudential supervisor. So it starts off with submission of attestations from chief executive officers of all insurers as well as banks that they are in compliance with the policy requirements in our FDFC policy document. We then overlay this with off-site surveys to assess compliance to specific parts of the policy document. We do on-site or thematic reviews on specific areas, institutions or products, which we have identified through our surveillance activities as possibly having higher likelihood of causing severe harm to financial consumers. So as an example, if I had pure protection products, more complex investment-linked products, I'd obviously spend a lot more time looking at the more complex products. Complaints is another good one. We monitor complaints data, and if we see sudden spikes in sales of particular products, we may want to have a look at that on an off-site level first, check whether we see any complaints, and if we do, that's when we might go in a little deeper, because we realize that, but if you want to go in when you have 1,000 complaints, the damage is already done. So what we're trying to do more and more now, we're focusing a lot on our surveillance tool in order to try and get ahead of a problem. We're still not preemptive. We still very much need to hear a complaint or two first, but and we have a long way to go. We are a relatively young department compared to our colleagues in Prudential, but we feel that we do need to focus a lot more on enhancing our surveillance tool, because We never have enough supervisors to keep up with the number of lapses that you're seeing out there in the market.
Brilliant. Thank you very much. Yeah, a lot of that does come down, doesn't it, to whole conduct culture, the harm that's being used. And certainly I know when I joined the FCA 3 years ago, getting used to that language in the regulator is very much a way of life now, as we talk about it. Vanessa, how about you? What tools do you have, and can culture be prescribed, and what about these bad apples, the ones that just kind of keep moving on, and how do you look at those?
So thanks, Charlotte. In terms of the rules that we have, our journey started a long time ago. I remember the TCF principles were published around 2010 when I was still working as a compliance officer in industry. And the FSB then came out with these rules, and we didn't know what to do with them as industry because it was fresh and new to us. We didn't know how to implement them. And so the FSCA realized that just having these principles is not going to be enough. And then we came out with what we call policyholder protection rules. We found that there was a set in the market of retail clients that were particularly exposed to these conduct risks. And these policyholder protection rules were very detailed rules dealing with claims, complaints, your processes, disclosures, terminations. It's kind of a rule book on how to apply the conduct. And we came out with that, and then we saw that it did have a good effect, but not as good an effect as we wanted. Because we found that when we engaged with insurers, they would come back to us with more of okay, so I've complied with this rule, and more of a technical response. I've done 1, 2, and 3, so you can't come after me as an insurer. And that was not the response that we wanted or expected. So we had to go back to the drawing board and say, okay, we know we have these principles, these TCF principles. Maybe we must entrench it into the PPRs. And that's what we did quite recently around 2018. And then after we did that, when we get similar questions from insurers, we go back to them and say, okay, you've shown us you've done PPRs 1, 2, and 3. That's great. But here's the outcomes. Show to me the evidence that you have complied with the outcomes. And that's where the insurers that have the wrong culture, that's where they're very quiet, or they come back to us with the if, but, and the ers. And we found that that's more effective now. We have the rules for those who are maybe very new to the industry and do not know how to operate, to tell them this is what you must do. And for those that are mature but still naughty, we have the principles as well to say, okay, here's the rules. You haven't met the principles. We're coming for you, in a nice way or in a not nice way if you're a very naughty insurer. So we've gone through a journey with respect to our legislation. I think somewhere along that journey as well, what really helped us is the return that I spoke about, the conduct return with the insurers. We introduced it a few years ago, and we've started to show the insurers all of these conduct indicators and the language that it speaks to us. So in addition to having the principles, they can see tangibly what are the indicators. On that return, we've got things like loss ratios, we've got claims performance, turnaround times. We have claims that maybe were policies that were sold, but they were not taken up. So that's just a few examples. It's a very long list of indicators. But through the dialogue that we've had with the insurers over the years with respect to the return and what it's showing us and what issues we've picked up, they started to understand how we expect them to behave as insurers that have the right type of culture.
Brilliant.
You also asked me, you also asked me how we are dealing with the bad apples. So we take a different approach depending on how bad the apple is. So we have various insurers and we risk rate our insurers. So the high risk insurers are the naughty ones. The low risk insurers are the ones that we leave alone as a regulator. And because as we were talking about capacity, every regulator has capacity constraints. We need to understand how we can focus. And how we focus is we risk rate our insurers. So we have different types of engagements with the insurers. We have the on-site inspections, which is a tool that we use less frequently than the other tools. We save that for the insurers that we're really worried about, or the ones that have started in the industry and are still new, and we need to go in and we need to show them how we think that they should be behaving. So those are the ones that we go and do very deep dive, intensive investigations with, and also hand holding with, depending on the nature of the insurer. Then we have what we call a complaints management process, whereas previously we were bombarded as supervision with the high volumes of complaints. We couldn't see what were the real complaints, what were the queries, what were the conduct related matters. So the FSC as a whole decided, let's rather have a business division that filters in the complaints, deals with the volumes, and only sends through what we see as the technical complaints. So as supervision, we can see, okay, this complaint has come through, it relates directly to culture, let me go and investigate, and then that will influence also the risk profile of that particular insurer. One of the big tools that we also use is our engagements with the different regulators, because we can't have eyes everywhere, but a lot of our entities operate through other pieces of legislation, which is regulated by other entities. So we keep them close to understand what is the risk profile in your space and how does it differ from ours? What are the red flags you are picking up? A key stakeholder for us is the Prudential Authority, because they look at the majority of the governance aspects, so board and board composition, auditor, control functions. And it's good for us to keep them close, because if they pick up issues there, chances are that's also going to impact culture. Also, we found that there's a strong synergy between solvency. As soon as solvency goes down, conduct also goes down. So we've seen that. That's a very useful relationship. And then the ombudsman. So in our jurisdiction, we have the ombudsman that deals with the complaints, and they also have a fairness mandate. And they look at the life and the non-life complaints. So we engage with them regularly to understand what trends they are picking up and who in their eyes are the naughty insurers, so that we can also try and align. So on an annual basis, we sit together as insurance supervision. We look at the risk profile of our entities, look at our experience with the insurers for that particular year, and then we adapt the risk rating, whether we move them up or down. Then in the following year, we decide how frequently or how close we are going to keep that insurer. In terms of the enforcements, we don't usually take the approach of hard enforcements unless it's a very naughty insurer. So that's the administrative penalties and fines, and maybe engage with the Prudential Authority with respect to possible curatorship. More often than not, the tool that we use is moral suasion. We pick up the trend, we speak to the insurer. If it's an insurer that's open to speaking, and that also depends on its risk profile and its culture, then we have a conversation and say, this is the issue, this is what we're picking up, this is our recommendation. If we find the insurer is not receptive, then we tend to then go the harder and harder route. Thanks.
Great, thank you. So it sounds like it's been great, kind of that suite of MI that you've been getting in terms of educating people and then holding them to account and setting where those expectations are. Just to kind of pick up as well on kind of answers as well for the FCA as well, we would look at the gateway, which I'm sure that you guys would as well, and making sure that if you've got someone that's left one firm that's not done well and tries to set up someone else, that we have a strict gateway to challenge those and look for certain levels to make sure that, because where we have got insights is what's going to happen below that iceberg.
Actually, Charlotte, funny you should mention that. When Vanessa was saying what are some of the indicators you could look at, which could indicate that trouble is to come, I'm sure you've seen this too. It seems to be revolving doors and a bit incestuous in our industry. You know, a CEO here for 3 years will end up in a different organization. So what we found is every time a new CEO comes in, that's when we really focus on any new products that come out, because as you know, they come in, they need to prove to the shareholders that they're worth the money. And so that's when we start seeing really short-term behavior. So Vanessa, you mentioned, right, when solvency or liquidity is affected, suddenly, they're desperate to get the cash in again. I also see this when you have particularly new CEOs who've come in. That's a red flag to us, as in, okay, let's watch that institution or that insurer a bit closer. Let's really scrutinize. I work with my Prudential colleagues to scrutinize the product design, and they have to submit to us the documents, their product design requirements and everything else before they launch a product. So yes, we have so many coming in. So when we select, we tend to focus on those. Which are the ones from insurers with very new CEOs?
Yeah, and as you said, as there does tend to be that rotation, and perhaps that will set up for another panel discussion as the IAS does more on the DE&I side of stuff and the benefits that can bring. So also move on this topic, talk about the impact of culture on the treatment of vulnerable customers and inclusive insurance. Maybe Xin, do you want to give some thoughts on that? How does it shape the firm's behaviour in treating vulnerable customers fairly or in a different way, or how does the right culture help firms see purpose in inclusive insurance approaches?
Oh, sure, Charlotte. I did try. I thought really long and hard, but unfortunately, I couldn't find an example of an insurance company. But I also did a lot of development work as well. And for those of you who are familiar with Grameen Bank, I see this as a great example of how strong corporate culture resulted in a complete transformation in traditional lending models to meet the needs of the most vulnerable consumers in Bangladesh in a meaningful way. So again, when I think about it, all the examples that come to mind of where good culture results in good behavior and good outcomes for consumers, it tends to be social enterprises, which are led by noble individuals with genuine intentions. I find these sort of enterprises tend to do it better. However, when it comes to profit-based organizations, whether it's banks or insurance companies, my experience so far shows that none of these organizations will voluntarily go the extra mile to ensure consumers are fairly treated unless there are strong incentives to do so. Vanessa's examples earlier of what they do in South Africa is a great example of the incentives you need to put in place in order to get your regulators to fall in step. So, for instance, I did mention that we issued our FTFC policy document in 2019, and we actually have a clear principle on fair dealing, which states that an insurer shall not impose conditions that are unfairly prejudicial to a particular financial consumer or a group of financial consumers to obtain a financial service or product. In particular, the insurer shall not treat the financial consumer or group of financial consumer less favorably solely on the basis of arbitrary factors such as their marital status, race, or religion. To me, that principle sounds clear enough. However, we are still receiving regular complaints from vulnerable consumers such as persons with disabilities who are denied any form of insurance at all. Another key requirement in my FTFC policy document on fair dealing talks about how we expect insurers to establish policies which require staff, representatives, and agents to carry out their duties and responsibilities with due care, skill, and diligence in accordance with professional ethical standards. In spite of this, we still receive regular complaints from irate consumers claiming to have been sold insurance products without their knowledge. This tends to be through telemarketing sales or being missold products that do not actually meet their specific needs and financial circumstances. So as a result of all this, even though we already have a principle-based, outcome-focused document which broadly suggests that there should be no discrimination, and going through this recent pandemic and extended lockdowns in Malaysia, we've really seen how you have financial institutions which do not have the ethos of treating consumers fairly, it can really lead to quite significant harm to consumers who can least afford to be treated badly. So on 28th of June, we have issued our exposure draft on fair treatment of vulnerable consumers. Once again, this is not something that we invented on our own. We did benchmarking and we found both FCA UK and the ASIC in Australia provided were pretty good benchmark countries for us to reference. Why is this necessary? We felt it necessary because financial consumers in vulnerable circumstances are more likely to have additional or distinct needs, which, if not reasonably met by insurers, could result in unfair treatment, undue financial hardship, or exclusion from essential financial services. And the aim of this new policy document is to promote a culture where banks and insurers are properly considering and responding to the interests and needs of vulnerable consumers in the way they conduct their business and operations, and set requirements and expectations for all financial service providers to observe to provide the appropriate support to vulnerable consumers consistent with fair treatment outcomes.
Thank you, Xin. Yeah, it's a challenge, isn't it? We all talked about kind of the regulation that's in place and the alignment, the modernisation that you put it as earlier, Xin, but yet still there is this challenge here. Vanessa, not got much time, 1 minute. Is there anything else that you would add on that particular topic?
Yes, I'll try and talk quickly. So we have a vulnerable market that, because we have clients with different education levels, we have a vulnerable market that tends to often purchase funeral products specifically, and their view on these funeral products is that they actually are life policies. And we've seen this pattern a long time ago. And what we've done is we have a separate department within Conduct of Business that specifically looks at this particular type of client base and how products are developed. And so there is, it's unusual for us because we do not have a sign-off process with respect to products for any other area, but particularly for funeral, we have a sign-off process because we need to keep that closer and also to protect those vulnerable customers. Thanks.
That's fascinating. Thank you very much for that, Vanessa. Right, now I believe that we are putting the questions out to the floor to see what you'd like to ask us. So, Janina, is there any questions that have come through? Maybe.
Not yet. So we haven't had any questions in the chat yet. So please, I guess, feel free to either post them in the chat or also raise your hand and you can unmute and ask your questions and come in with any comments as well.
Maybe if whilst everyone's, I'm assuming they'll come in on the chat bar that we'd see, but maybe if whilst everyone's having a bit of a think, well, we've got 10 minutes for this slot, so please do put the questions in if you think of any. But maybe, on the call, I'm sure there'll be lots of different jurisdictions at different stages. We talked today about the different evolutions that we've had in conduct regulation. What do you think people should look out for when implementing the new conduct and cultures in the context, perhaps with previous little experience? What would be your kind of top lessons learned? Maybe Vanessa, do you want to answer that one?
Yes, thanks. Often when insurers approach me and they explain a scenario or what they want to do and how it's in the best interest of customers, I always say to them, I'm a regulator. I don't believe you. You will need to prove it. So I often find that you need to explain to the insurers that they need to keep an evidence trail. Secondly, when you initially assess the insurers, you need to get a good picture of what their risk profile is, and also be mindful that it's not a one size fits all approach. I mean, we spoke about the different layers in management and how they are supposed to translate the messages within the different layers in management. And when we do an on-site at a very big insurer, it's much easier to see the evidencing. But we need to be mindful that with small insurers, it's much more difficult. So one small insurer that we went to, when we asked them to evidence how they talk about culture, the manager said to me that, well, I go to the desk of the other manager and then we talk about a particular complaint or we talk about a particular process, we come to a resolution and maybe we'll send an email. And we need to be mindful that, just an email is fine as long as we can see that the outcome has been achieved. And I think it's not, culture is something that is very difficult for you to assess upfront. It's much easier once you use various tools in order to get a much fuller picture, because I found that what insurers tell me at face value, if I don't use the various tools to test it within different, in different ways, it's very difficult to get a good sense as to what the culture of the entity is.
Brilliant, thank you. Yes, it is the need for some kind of trail, and I think the reason as well we keep talking about harms is because the harm is the visible part of it. That's where we can start seeing that things have fallen down because of that conduct culture area. In the UK, we introduced the Senior Management and Certification Regime, SMCR, which also aims to reduce harm and to consumers and strengthen market integrity. As part of that, it looks at kind of people taking individual levels of responsibility for different pieces, and when it was mentioned earlier, attestations as well, that would be a tool that we would use to get that level of understanding that they will be delivering to that level. But Sin, is anything that you would add to that?
Well, I'm taking this question from the perspective more of regulators, right? That just referencing my own experience, where we started out more as a prudential regulator traditionally, and then picking up conduct along the way. So for those of you who are also in that same journey now and are thinking of forming your own conduct function, first and foremost, you're going to need your prudential supervisors and your prudential regulators as your base staff. You start there. However, once you've got them in that department, you need to rewire their whole thinking because for prudential, the bigger the organization, the bigger the risk. The smaller the institution, the smaller the risk. It tends to be opposite when it comes to things like conduct and anti-money laundering, where it's the smaller institutions who may not have as much funds, who will then probably be more subject to coming up with harmful products. They are the ones that have to catch up with the big boys. So they will be the riskier ones. They will be the ones trying to corner a market. And that's where you'll probably find the dodgier deals as far as consumers are concerned, right? So that was the challenge we had. We had all these prudentially trained people, myself included, and we went through a painful process of realizing I need these skills in policy making, in understanding how to deal with institutions, in understanding how to supervise, but that's about it. We had to look ourselves at our whole approach, how we risk rate. So while we use the same tools, we had to really, it was a test, it was as we were doing it, then we realized, oh, wow, completely wrong. And it's a trial and error, you fix it along the way, but what we come to realize now is, okay, great, we can start with prudential, because obviously, right, it's generally when you have to form these things, there's a lot of public pressure already, you don't have that much time. So to get it going, start with your existing prudential resources, but you have to very quickly have a team look into how you need to change your existing tools, approaches, and processes to suit your focus in conduct. And a key thing is then something prudential supervisors never do. They look at severity in terms of, will the institution fail? Here you need to look at severity from the harm, from the perspective of the individual consumer.
Great, thank you. Yeah, and as well, coming through on that, and one of the points earlier that Vanessa made, that communication piece with other authorities, entities and staff to really make sure that we're getting all that together to understand what's under the iceberg. So Lauren, thank you very much for your question as well, that says, what one thing do you think is most influential in ensuring a frontline employee acts consistently with the culture that the board wants to have in place? Vanessa, do you want to answer that?
Yes, sure. For me, it's effective communication and messaging, which is an easy thing to say and appreciate, and a very difficult thing to do. When we conduct on-sites, we speak to the person on the ground who's dealing with complaints, and we ask them, what does treating customers fairly mean to you in terms of the day-to-day work that you do? We ask a similar type of question to middle management and to higher management. And we also sample the governance documents and the reporting that goes to senior management to see whether the information is flowing upwards, but also flowing down. So it goes back to culture. If the organization has the right type of culture, then it will be able to communicate that messaging to everyone within the organization, including the frontline person that is the touch point for the client.
Lovely, thank you. Sin, is there anything that you would add to that?
For me, it's more consequence management and reward, right? If even on the front line, if you have the CEO saying, we've been watching, we know this particular staff on the front line in this branch has had excellent customer service, well done. And you actually see consequence management, as in colleagues who are constantly giving out bad advice, they need to know that someone's actually listening to all these recordings that go on, and actual acknowledgement of good and bad performance. It's nothing like that to prove to the front line that your board telling you that customers are important, we want you to treat them fairly, and then seeing those who do it being rewarded and those who don't facing some consequences. That works.
Yeah, definitely. And that kind of comes back to one of those diagrams as well that Lauren showed us earlier. I mean, at the FCA, we split it slightly, but it's essentially the same things in a slightly different order, where we have purpose, leadership, and then the approach to rewarding and managing people and governance and all those kind of things coming together. Interesting, we did a Transforming Culture conference, and also themes there that we're going to explore further are psychological safety over fear, leadership and management capabilities, and then again incentives and recognitions and firms' assessments of culture. So that, yeah, incentives is and consequent management is big, the governance side of things. Brilliant. Thank you all very much for your time today, Vanessa and Sin, and I'm going to hand back to Janina.
Thanks very much, Charlotte. Well, then I'd also like to thank our excellent speakers today, Lauren for the introduction and sort of giving us some insights into the topic. That was really great. And then, of course, to Sin and Vanessa for making the whole topic a bit more tangible and sharing from your experience. That's been really great. Then, of course, to you, Charlotte, for moderating the discussion. It's been great having you all on the call today. The next dialogue of the IIS and the HRI will take place on 29 September, and we'll talk about regulatory challenges and supervisory demands in facilitating remittance-linked insurance. So also a very interesting topic, and I hope you'll all join us again. There will be more information on our website.